Hey, I'm Chris Perras, Chief Investment Officer at Oak Harvest Financial Group. We're an investment management and retirement planning advisor located in Houston, Texas, and welcome to our November 19th YouTube Stock Talk, keeping you connected to your money. Title of this week's podcast is It's Silly Season and It's Going to Be Okay. 2 weeks ago, our podcast previewed a short period into mid-November, highlighting potential higher stock market volatility caused by fast moves in interest rate markets. We base this analysis on real-time indicators we use, none of which has anything to do with government economic data. And so far, indeed, we've seen a pickup in volatility and a fast dip down in the overall markets. Please go and subscribe to our Oak Harvest YouTube channel if you're interested in our original content. Last week, we recapped our fourth quarter 2020 Ignore the Political Pre-Presidential Swirl. This is how early bull markets look. It's time to get aggressive call we made way back last year. Viewers new to our podcast can Google Oak Harvest, Waiting No More. This is how early bull markets look. This podcast was released on Friday, October 30th, 2020, pre-presidential election. We followed up that podcast with a few others in November of last year titled Early Bull Markets Buy the Dips, Making Sense of It All, and another one titled Santa Shops Early. That was November of last year. I mention this now because while our team is still very positive on the remainder of 2021 and early 2022, for reasons we've repeated every dip along the way this year, we appear to have entered what I refer to as the silly season in this stock market cycle. And in our opinion, that's okay. Our investment team has seen this stuff before. As always, we're here for our clients, and we've been working in the investment management industry for over 25 years now. Most of the time, I've been working as a generalist, a portfolio manager, or an analyst allocating investors' money across multiple sectors and industry. And on several occasions, I've been privileged to see and live through the dynamic currently playing out in front of me. That's a nice way of saying I'm getting old, I've lived through a few cycles, and I've seen this play a few times, and I've seen the ending. Its script is almost always the same. It reads like this. The economy and stock markets experience a shock caused by a black swan one-time event like COVID this time, or 9/11 attacks, or they experience a buildup in excesses over years. Think of the internet expansion in 1997 through 2000, or overinvestment in real estate markets in 2003 through 2008. Subsequently, we experience an economic slump and a recessionary drop of over 30% down in stock markets happening over some time period. This time, it was a COVID outbreak, and our response of closing down our economy induced a recession that caused a drop of roughly 35% on the S&P 500 in only 4 weeks last year. Subsequently, the Federal Reserve responded with monetary policy, and our federal government responded with fiscal spending policies, and the stock markets recover first, with disbelief by most TV prognosticators and those calling for depressions, followed 6 to 9 months later by the economy digging itself out of a hole. Of course, looking back at the last 18 months, this is almost exactly what happened. Against the ongoing calls of unprecedented stock market action and ongoing calls for double dip recessions, or that there was no chance of an economic recovery, the markets have recovered almost precisely in line with its normal behavior this cycle. Since 2009, during QE, under a first-term presidential term, Obama round 1 in 2009, Obama round 2 in 2013, Donald Trump's first year in 2017, and now President Joe Biden in 2021. The stock markets have all behaved almost exactly in line with each other each year. And guess what, viewers? The stock market sits near all-time highs, and the money that was pouring out of the markets in March and April of 2020 at the market lows is pouring back into markets. Remember, listeners, Fidelity Investments did some research in the second quarter of last year into their clients' behavior, and the data said that 30% of people over the age of 60 sold all their stock holdings, sold 100% of their equity holdings out of fear of the COVID virus. Well, that money is now cascading back into the markets with the S&P 500 up over 100% off the COVID lows. So much for the notion of buy low, sell high. And investors who sat back in mid-March and April of 2020 and didn't demand or tell their advisor to get me out or take me to cash are probably pretty happy right now. And those who had cash on the sidelines back then and pushed some of that money into new or existing investments are likely even happier. But many investors who first waited for the smoke to clear on the virus, Then they waited on the presidential election outcome. And finally, they waited on the improving government economic data before adding to their portfolios. Well, most likely, many of them are feeling behind the curve in their own minds. They might be starting to feel a little jealous of those stories they're hearing on TV about all the money others are making trading Tesla or investing in Bitcoin and other digital assets, when that digital asset was $7,000 in April of 2020 and is almost $70,000 now, 18 months later. The rally in risk assets has been going on now since April of 2020, or about 20 months. I believe, based on my own work, that this type of bull market rally, their initial rally off the bottom, lasts close to 23 or 24 months before you get a significant peak. A peak and then a correction of 10 to 15%. So while statistically speaking, we still have a few months left in the initial stages of this wonderful rally, I think we're now close to the last couple of innings. And viewers, just like the last few innings of a tense baseball game or a close football game, those final couple of months into the peak are usually the most exciting because those final few months are normally some of the most profitable months to those who invested early. I repeat, those who invested early. But this period can also be one of the most difficult for those latecomers to the rally on the other side. So what happens normally in the final few months after 2-year moves? Stocks start to make exponential moves up. So for those of you who've forgotten your math, what does that mean? It means that a dollar gain and the percent gains start to accelerate upward at a faster and faster rate. The price moves on stocks that are leading go from, say, 50 cents a day increases to a pattern something more like this. First, it's 50 cents a day, then $1 a day, then maybe $2 a day, then maybe $4 and $5 a day, and onward, upward to $10 a day a share. So the percent returns actually accelerate exponentially on the upward move. And if you're already in these names, it's exciting, it's exhilarating, and man, it's fun and it's profitable. Looking back here on the chart, you'll see this on the S&P 500 in 2017, late in the year. On a monthly basis, the average went up 2.5% in October, then 3.5% almost in November. It kind of settled down in December. Some people took gains, and it was up about 1.5%. And then in January, I think most people remember, it was almost up 7.5% into the Trump tax plan. But make no mistake, you are not a genius because of this, unless you recognize it for what it is. What is it? It's other people's FOMO. That's fear of missing out. And it's a massive tidal wave of money flowing into your investments that you already own. The last 4 weeks have shown us a preview of the silly season in many stocks. Other people on TV will likely deem this the Santa Claus rally in December sometime. But listeners, our view is this. This began on October 4th when hedge funds were being forced to liquidate their portfolios and retail flows into the stock markets for the fourth quarter started to pick up. One need to look no further than Tesla stock, which is albeit an amazing company. Here's Tesla right here, back here in this chart. The stock has moved up over 55% in October alone. However, since the early October lows in the S&P 500, when many in the TV world were predicting a minus 10% October correction in the markets due to some Chinese real estate company imploding, Tesla stock rallied 55% in 4 weeks on the back of speculative retail call option buying. That's not fundamentals. That's supply demand for a stock and money flowing into a theme. That's trading and positioning and retail speculation through call buying. And yes, it's profitable and it's really fun if you're early to that game. However, it's an indication that we are in the later innings of a roughly 2-year initial move up in the overall markets and economy, not the first half. I'm doing this now because the team at Oak Harvest has decades of experience at actually managing other people's money in the markets in real time, not just pontificating on economic and academic theories in newsletters, on TV, or on Twitter. I'm doing this now to alert everyone watching or listening in advance to what we think will be happening in the markets over the coming months. And a period of silly season is very normal price action in the markets, which brings me forward to today. The silly season should be upon us shortly. And yes, it's really fun if you're already holding those names that others are starting to pyramid into late in the moves. However, while we continue to see an aggressive fourth quarter rally and early 2021 rally led by large cap technology and growth stocks, don't be surprised that if and when the markets and individual names start to have exponential moves up over the next 2 months, we will not be the advisor cheerleading at the front of the pack. that the need for you to buy more of the winners in 2021. We will not be the advisor who is late to the party and thinks they can be the last one to leave. We could not have been clearer in October 30th, 2020 podcast entitled, Waiting No More, This is How Early Bull Markets Look, that was the time to have FOMO, if you wanted to have it. That was the time to fear missing out on 2021. And now as we enter silly season, it's time to go back, slow down, sit back, and enjoy the surroundings in the 2021 party. It's time to let the latecomers to the party scramble around for the remaining food and drink. Let's let them fight it out and scrum for the last of the best of the food. Viewers, silly season is a blast of a party, but the hangover can leave those who show up late and eat and drink too much late in the evening. Well, that can leave them with one hell of a hangover in the morning. Should we get the fourth quarter silly season party, we would expect a material uptick in realized volatility later in the first quarter of 2020 and a bit of a market hangover. And for our clients, just as we've been all of 2021 on the way up, we will be there for you throughout any stock market correction or hangover. Those are the times when you should understand that the relationship we have with you is first based on your goals and needs. That is how much do you really need in retirement on your budget versus your greeds, which is how much you want in retirement to satisfy your life beyond your goals and your budget. Viewers, give us a call here at Oak Harvest and ask to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Call us here at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Perras, and have a great week.